The rapid expansion of artificial intelligence data centers has completely separated itself from the constraints of traditional public grid planning. Generative AI training clusters operate under a strict power profile. They require hundreds of megawatts of electricity continuously, demanding an uptime reliability of 99.999%. Variable renewable energy sources, like wind and solar, fail this continuous density test. Their physical output drops when weather conditions change, which forces data centers to rely on massive, expensive battery arrays to prevent system failure. Nuclear fission is currently the only carbon-free technology capable of providing this continuous baseload. Baseload refers to the minimum, unvarying amount of electrical demand required on a grid over a 24-hour period, which must be met with constant generation. But procuring the generation source is only half the equation. The most severe bottleneck is the geographic and regulatory process of physically connecting gigawatt-scale loads to the public grid. Regional transmission organizations, or RTOs, are the independent agencies that coordinate, control, and monitor multi-state electricity grids. Today, these agencies face massive interconnection backlogs. Across constrained regional markets, average wait times for new large load requests extend between 5 and 7 years just to secure access to the transmission wires. For technology hyperscalers, waiting 7 years for power means a 7-year delay in launching new AI models and securing inference revenue. To mitigate this existential risk, they are engineering physical bypasses around the public grid entirely. The primary engineering solution to this bottleneck is the behind-the-meter, or BTM, co-location strategy. BTM refers to a specific electrical configuration where an industrial facility consumes electricity before that power ever passes through a public utility revenue meter. This diagram contrasts a traditional grid connection with a behind-the-meter co-location. Traditionally, electricity travels across high-voltage grids and clears a utility meter. But behind the meter, the data center intercepts the electricity directly from the generator, completely isolating power flow from regional transmission lines. Because this unmediated physical flow of electrons does not utilize public high-voltage lines, the data center completely circumvents the multi-year regional interconnection queue. This technical loophole has catalyzed a wave of bilateral agreements between tech giants and independent power producers at an entirely new scale. This table lists key U.S. power plant co-location projects. Amazon Web Services committed to drawing up to 1,900 megawatts from the Susquehanna nuclear plant, while Microsoft contracted for 835 megawatts to restart a reactor at 3 Mile Island. Intercepting power at this magnitude rewrites the traditional utility revenue model, removing massive blocks of dispatchable energy from public capacity auctions. By eliminating the interconnection queue, tech companies converted historically stranded nuclear assets into an operational moat, securing their AI infrastructure rollouts against bureaucratic gridlock. Prior to the AI boom, merchant nuclear operators struggled economically, forced to sell their wholesale power into congested regional grids, where prices were deeply depressed by cheap natural gas. Through the late 2010s, historical baseload profitability for these facilities hovered between a mere $35 and $43 per megawatt hour. Today, hyperscalers are executing 20-year power purchase agreements at massive absolute premiums to secure that exact same output. A power purchase agreement, or PPA, is a long-term financial contract between an electricity generator and a buyer to guarantee a fixed price for energy over a set duration. This chart tracks nuclear power transitions from commodity pricing to premium tech contracts. The gray bars show the historic baseline, while the blue bars reveal the severe price inflation executed by companies like Meta and Microsoft for their next-generation contracts. Market analysts estimate the Microsoft Constellation deal to restart the Crane Clean Energy Center commands between $100 and $115 per megawatt hour. Securing a fixed-price buyer for 2 decades transforms a highly volatile merchant commodity into a predictable, utility-like annuity for the nuclear plant operator. In response to these guaranteed long-duration cash flows, financial analysts recategorized nuclear operators, assigning them the elevated valuation multiples typically reserved for high-growth software firms. While the equity market views this as technology companies wildly overpaying for legacy infrastructure, an analysis of the specific costs bypassed in these deals reveals that this 200% premium is actually a calculated illusion. This chart visualizes the economics of these deals. A $105 contracted rate appears irrational compared to a $35 historical baseline, but the equation balances when we factor in the specific grid expenses the data center avoids. The first major avoidance is the Network Integration Transmission Service tariff, coupled with regional capacity market charges. Network Integration Transmission Service, or NITS, is a mandatory fee charged to utility customers to fund the upkeep and expansion of the high-voltage macrogrid. By operating completely off-grid behind the meter, the data center legally bypasses these hyperinflating regional charges entirely. The second significant deduction is thermodynamic transmission line loss. Routing power over long distances through a traditional grid results in a 5 to 15% physical loss of electricity. Co-locating at the generation source eliminates this thermodynamic penalty. There are also massive capital expenditure savings. With the continuous physical output of a nuclear reactor, the data center operator does not need to build localized arrays of backup diesel generators or lithium-ion batteries to offset renewable intermittency. When we account for the fully loaded grid costs, the true implied premium drops drastically from 200% to roughly 27%. Hyperscalers accept a 27% premium over the 20-year life of the asset because it guarantees absolute speed to market and 100% carbon-free uptime. The localized economic efficiency of the behind-the-meter bypass triggered a violent response from traditional, regulated utility companies operating the broader grid. Their central argument is rooted in supply math. Siphoning gigawatts of existing baseload generation away from the public creates an immediate supply vacuum that threatens the reliability of electricity for millions of commercial and residential consumers. Utilities formally protested these TEF nuclear partnerships, labeling the co-located data centers as free riders. Even when positioned behind the generator's meter, these data centers remain electrically synchronized with the transmission system. They implicitly rely on the macrogrid's physical inertia to maintain exact frequency stability, and they depend on it for backup power if the nuclear reactor trips offline. Utility operators estimated that avoiding transmission tariffs in the Susquehanna behind-the-meter arrangement alone would shift up to $140 million in annual grid upkeep costs directly onto residential ratepayers. This friction forced an intervention from the Federal Energy Regulatory Commission. FERC is the independent United States agency that regulates the interstate transmission of electricity, natural gas, and oil. This timeline illustrates the regulatory escalation. After officially rejecting an amended co-location agreement in November 2024, FERC issued a sweeping generic order in December 2025 that rewrote the rules of engagement. Under the new federal mandate, co-located loads must contribute to system-wide regulation and black start costs on a gross demand basis. They are legally barred from using the public macrogrid as an uncompensated backup battery. This regulatory hammer effectively destroyed the unregulated economic loop that made pure behind-the-meter configurations so lucrative, forcing the AI infrastructure industry to rapidly restructure its approach. Recognizing the escalating legal risk, Constellation Energy preempted the regulatory crackdown by pivoting to a front-of-the-meter, or FTM, architecture. FTM indicates that the electricity flows through the public utility meter and the standard transmission grid before reaching the end user. Constellation's landmark agreement with Microsoft to restart the Crane Clean Energy Center operates entirely under this FTM case study. Instead of isolating the load behind a private wire, the restarted nuclear plant will inject its full 835 megawatts of carbon-free capacity directly into the regional transmission grid. This table compares the grid interconnection realities. The front-of-the-meter paradigm abandons foregoing a grid connection, providing power directly to the public network. The Microsoft data center draws power as a standard retail customer. Moving down, operating on the grid means the data center pays significant transmission charges, lowering costs for all other customers. Despite operating on the public grid, the rigid physical structure of the power purchase agreement allows Microsoft to synthetically claim 100% matched carbon-free energy generation to satisfy its corporate sustainability mandates. The brief era of unmitigated grid arbitrage is over. By sacrificing marginal behind-the-meter cost efficiencies to secure front-of-the-meter regulatory certainty, operators have positioned the United States nuclear fleet as the legally sound, irreplaceable backbone of the global AI economy.